Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes here on Options Guide TV. Today, we are doing an Education Friday offering on Options Guide TV. We usually like to do this around the holidays, so this is a pre-recorded show. Recently, the last few holidays, we've done the definition of delta, also the definition of gamma, and today we're going to talk about theta. So if you want to review, you can hit pause right now and go check out episode 22, that's regarding delta, and episode 48, that's regarding gamma. So now, today we're going to talk about theta, and honestly, gamma and theta are brother and sister, if you will, in that when you talk about gamma and you talk about the acceleration of the option contract, you're also going to have high theta, and that means high time decay. So if you have an explosive option contract that will reward you quickly if you're correct on your forecast, you're also going to have an option contract that will have a large amount of time decay, and you can't have one without the other. So we're going to start by defining theta, and then we're going to look at a real option chain, and we're going to see how theta changes as we go through time, how that affects delta, and how that affects gamma. So we're going to tie all three of these Greeks that show up in an options pricing model. We're going to tie it all up and talk about the theory, and then we're going to actually look at it live in real time. So let's start by running over to the Options Playbook, the Options Playbook website, optionsplaybook.com. And if you go to the option basics section, there's a section called Meet the Greeks. In here we have the definition of all the Greeks, but we're focusing on theta. So let's talk a little bit about theta. If you scroll down in that section, you will see, obviously, the word theta, and that's time decay. It's enemy number one to the option buyer. On the other hand, it's usually the option seller's best friend. So it tells you how much your option contract will decay for 1 day's worth of time. Now, you can get thetas that will be sometimes on longer term options. You'll see thetas displayed in a 7-day theta or even a 14-day theta. So theta is just a theoretical number, and it depends on how the options pricing calculator is set up for you to determine what theta you're going to receive. Inside the Tradier TradeHawk software, they do a 1-day theta. So let's just talk about time decay in general. If you look at this little chart here, we have, when you look at option contracts, not only do they decay, but they decay at an accelerated rate. So if you look at the Black-Scholes pricing model, the model that actually started all these pricing models, the godfather of pricing models, if you will look at that model, and inside there you'll see a lot of square root signs. And that's because, are you sitting down? You ready for this? Options decay at the square root of time. I know that's an amazing fact, and you might want to tell all your friends about this at the Thanksgiving Day festivities. But what does that mean? That means that if you take the square root of time, and this actually works out pretty well in the theoretical actually goes along pretty well with the real world. Out of all the pricing model things, time is time, and every moment that goes by, that option decays. And if it's got time premium in it, that time premium is going to decay. And in this example that we have here inside the options playbook, we're looking at an at-the-money option contract. That is the option contract that has usually in that expiration the highest rate of time decay. Why is that? Because that's where all the premium sits. On that at-the-money option contract, there's a ton of juice, to use that technical term. So in this instance, if we have a 90-day option contract and we see that that's trading for $1.70 and 1 month goes away, well, we're going to lose 30 cents on that option contract. So a 90-day becomes a 60-day. We have a nice smooth, for lack of a better term, rate of decay. So we go from 170 down to 140. And then when another 30 days go by, we go from 140 down to 1. Now notice this was 30 cents. Now this is 40 cents. And then in that last 30 days to expiration, now once again, we're assuming this is an at the money option contract. It's like, wham, my sled hit the tree, right? It's got to go from 1 all the way down to 0. So we started at $1.70. We had a slower rate of decay. When a 60-day became a 30-day, then we had a little bit more decay in that time period. And then in that last that last stint from a 30-day down to a 0-day option contract, we lost that entire time value of that at the money option contract. Okay, so if you went back and you paused and you reviewed the gamma video that we recently did, you would know that, guess what? The most explosive option contract is the near term at the money option contract. The one that we're talking about. Out of these 3 expirations, this is the nearest term at the money contract. And you see there's $1 worth of time premium in theory on this graphic that we have. Out of those 3 options, this is also going to be the most explosive one. That means that if you're at the money and the option contract gets in the money, well, at that moment, gamma explodes delta, and delta moves very quickly either towards 1 if it's going in the money or towards 0 if it's going out of the money, because delta is telling you how much your option will move relative to a 1-point movement of the stock. The deeper we are in the money, the bigger the delta will be. The further we are out of the money, the smaller the delta will be. Gamma is going to push delta. It tells you how much your delta should move relative to a 1-point movement in relative to a movement in delta. Gamma will tell you how much delta should move when the underlying stock moves $1. Okay, I said that a little better that time. So if I look at this, gamma is the most explosive on the at the money option contract, because on that at the money option, we're talking about a 50 delta. So the furthest away from 1 is 50 cents in that instance, right? Either if it goes up, the most it can go to 1. If it goes down, the least it can go to is 0. So that at the money contract is where you see the biggest delta. That's also where you see the biggest theta. So do I want explosive option contracts where the delta skyrockets quickly towards that 1 number if I'm correct? The answer is yeah, I do. I want that. But do I want slow decaying option contracts? Option contracts in this with this nice smooth rate of decay throughout the life of the option contract? Yeah, I want that. But guess what? I can't have both. I can't have my cake and eat it too. So a lot of times, actually, when you looked at the market makers' pricing models, if you will, they would actually take a ratio of gamma to theta because it's such an important relationship. They made a new Greek for it. You don't see it a lot in the retail space. Not a ton of people talk about it, but I've heard it called alpha, epsilon. They just give it a different Greek letter, and all they do is literally divide gamma by theta. And that gives them a feeling for that relationship between time decay and explosiveness of that option contract. So with that said, I'm going to go over to one more tab, and I want to do just a small little iteration here. We've released. Let's run back to the playbook for 1 second. We've released a new version of the Options Playbook website, and I want to do a little bit of a push. You know, obviously, Options Playbook and Tradier, they go hand in hand together. I love doing webinars inside the Tradier Hub. So if you want to open up your brokerage account, you can do it directly from the Options Playbook website. All you have to do is look at this little banner here on the left-hand side. It's throughout the Options Playbook website. And then more importantly, I say with a wink, if you'd like to go and buy the Kindle version, we just released a new Kindle version of the Options Playbook. You can buy one on Amazon today. If you click on this link, it'll take you right to it. So check that out. Okay, now let's tab over to the Options TradeHawk software. And let's pull this up. And all I have now, all that I'm showing you is an options grid. And the markets are live. We're rocking and rolling. We're taping with the markets open. We're looking at the SPY, which is the ETF that tracks the S&P 500 index. We're looking at that because they have 1-point strikes, and it's a very liquid, very well-priced marketplace. A lot of times you see 1 or 2 cent differences on the at-the-money option contracts between the bid and the ask, which means we have very liquid markets, which leads to very well-priced. They match the models fairly well when you look at the pricing in the SPY, and very liquid underlying stocks. Okay, so on the left-hand side, we have calls. On the right-hand side, we have puts. The underlying stock right now, SPY, is at 455. So here's inside the options grid of the TradeHawk software, we highlight where that strike price is at. So we have bid, we have ask, we have delta, gamma, theta, and then we have extrinsic value, which is time value, and that's what we're dealing with here. I've gone out 16 days, which is the Friday expiration in December. In the SPY and the SPX, a plethora of different expiration dates all throughout the week, probably the most expiration dates of any underlying that trades options on any of the exchanges. So December 16th or December 8th is that expiration date. We have 16 days until that expiration. If I look over here on the chains, it shows me that. And we see, like I mentioned, with the stock at 455.29, so it's a little bit in the money. We see that the delta of the at-the-money option contract is 55, or you could say 0.55 if you don't look at it on a 100 share basis. And then over here, you note that if you take 55 and you add 45 to it, this is the put side of the equation. Here's the delta there. And that makes sense. That shows you how well these markets are priced, in that if I add the delta of the call and the delta of the put, they should add up to 100. And that will happen. Now, you'll notice that the delta is negative here because on puts, if the stock goes up 1, the put goes down in price. If the stock goes down 1, the put goes up in price. So it's the opposite of the call, if you will, for lack of a better way of saying it. And normally the deltas will add to 1, especially in very efficient underlines. Now, what did we say about gamma? Gamma is the most explosive on the at-the-money option contracts, and then slopes get smaller and smaller as you go deeper in and deeper out. And so we're going to concentrate on the call side of things, and you see the most at-the-money option contract, the delta is 14.98 right here, or 0.149 if you want to put it that way, divided by 100. And as we go deeper and deeper in the money, we stay right about here. This one's actually got a little bit more gamma in it, and that's a little bit to do with the curve, but we're not getting into that much detail. Well, I'm sorry, theta. This is theta. This is gamma. This is gamma. As we go deeper and deeper in the money, yeah, that's the biggest gamma is right here at the 147. We see gamma get smaller. Once again, why does that happen? Well, delta is approaching 1. So quite simply, you look over here, you see delta is approaching 1. Gamma's got to get smaller because it can't push it beyond 1. That simple. Can't push it beyond 1. We go further and further out of the money. Delta's getting smaller and smaller. Gamma's getting smaller and smaller. Why? Because it can't push it beyond 0. So most explosive option contract in that expiration are the at-the-money option contracts. And this is the one that you usually see a lot of the volume, a lot of the open interest, because something's going to happen with that option contract. It's that straightforward. Now, I would like that contract, but if I look at theta, look at what happens with theta. Theta is largest once again for the at-the-money option contract. As we go further and further out of the money, or in the money, it gets smaller and smaller. Why? Because intrinsic gets smaller and smaller. First off, so we have less time value the deeper we get in the money. And we also have less time value, extrinsic value here that we're showing on the chains as we go further and further out of the money. So not as much time premium. Theta is going to get smaller and smaller. So you have a very explosive, the at-the-money option contract is a very explosive option, no matter if you're looking at the call or if you're looking over here at the put. Here's the gammas on the puts. It does not matter. They got very explosive option contracts, but you also have a huge amount of time decay on both sides of the coin when we're looking at this. So high gamma, we're going to have high theta. That's the moral to the story. Low gamma, we're going to have lower theta. And how now I want to look at, well, what happens as expiration approaches? What's going to happen to gamma in particular on the in-the-money option contracts and the out-of-the-monies if we say we're no longer on a 16-day option contract? Let's jump up to the 5 days to expiration. So in this instance, what's going to happen to the in-the-money options delta? And let's focus at the 450. We see that's trading around 74. And then let's also go up and let's look at the 460. And that delta is around 35. Pay attention to those and look at what we have for gamma and what we have for theta. Okay, so let's come back. We're on the call side of things. And notice what just happened to delta. It just exploded, didn't it? It went from about 78 on that 450 to about 98. Well, now we're deep in the money, very little chance of it going out of the money. So as delta approaches expiration and I'm deeper in the money, my gamma gets bigger, or my gamma pushes delta to the limit, basically. And in this instance, on this 450 strike, we got a delta now of 96. So we got a very explosive option contract. So if we're correct on our forecast, for every point that it moves, our underlying should go up about $1. Now let's go and look at the exact opposite, the 460. Now delta went from about 30 on our first expiration down to about 11. Why? Less probability of the underlying stock actually reaching that strike. So it reacts differently. Gamma gets smaller in this instance, once again, but as we go further and further out of the money, the lower it's going to push it lower and lower. The lowest that it can go in this instance is going to be 0 as we scroll further and further out. So gamma gets smaller and smaller in this instance because we're getting further and further out of the money. But the bottom line is when you're deep in the money and expiration is approaching, that delta will skyrocket because of what gamma will do to it. Also, now look at our time decay. Our time decay is a lot more. Why? Well, it's not a lot more. It's a few pennies more. Why? Because we're in that high part of the curve, right? We're in that last couple of weeks to expiration. We have 5 days remaining. This is the November 27th expiration date. This premium has to go down. So every day that goes away, this theta would be 0.16. We're losing 16 cents on this option contract if the underlying doesn't move at all. But we also have a very explosive option contract that will push this at the money option contract towards 1 quickly if we go into money, and actually out of the money, it's going to go down quite a bit. Okay, so what's the moral to my story? We want explosive option contracts. We want delta to get to 1 if we're buying a put or we're buying a call. -1 on the call side or on the put side, or 1. But we also want to have lower rates of time decay. So what is that correct ratio? Where do you want to be? I know a lot of people, let's not think about the buying of option contracts. I think of people that are selling option contracts. And there were a lot of market makers on the floor that when we got down to this expiration, basically 7 days remaining, the November 29th expiration, they didn't want to sell those option contracts. They just wanted to close out those positions. Why? Because as you get deeper into money, and let's even go to the extreme here. We can do, that's 0 days. Let's do 2 days. Okay. Now watch how quickly we get to 1 on this option contract and how gamma pushes it that way. We do this, and now that 450 strike is now at 100 delta, right? We get to almost it gets down to 50. Well, at 52, we have a delta of 90. It only takes 3 points for your delta to get to almost a one-to-one movement with the underlying stock. So that's great if you bought that option contract and that happened and became 3 points in the money. But man, does that hurt if you're short that option contract. So where's that happy medium? Well, that's why people have, why a lot of option market makers and people that are getting into the heavy day trading of options, they like to look for a ratio between gamma and theta. We don't display this in here, and it's not very common that a lot of people do, but you can understand, if you understand the relationship between gamma and theta, you can understand why somebody would want to know that ratio. That's straightforward. All right. Well, I hope you have a very happy holiday. And that's going to be it for this education edition of Options Guide TV. We'll see you, in this instance, we'll see you on Monday for the next live taping of Options Guide TV. Please click subscribe, ring the bell so you get all the notifications, and pound that thumbs up, and we'll see you shortly. Thanks for coming, everyone.